Well, as mortgage rates hold steady and home prices still continue to stay elevated, many young home buyers are deciding to go with the adjustable rate mortgage for their option with the hopes of refinancing in the near future. But are there big risks associated with that? We'll tell you coming up next. Welcome to the Smart Mortgage Show. I'm Ben George with Bill Litton, Regional President at Cross Country Mortgage. You can find everything online at smartmortgageshow.com. As I mentioned in this video, we're going to talk about this adjustable rate mortgage, maybe trend we can call it, and where it can maybe be a problem for you in the future. So, Bill, I want to reference a Fortune article, which we're going to drop in the show description. You can find it there if you want to read it for yourself. But here's the headline. I'll tell you the headline. You can kind of give me your reaction because, headlines oftentimes don't paint the full picture, and they're also used to be emotional and to drive emotion for you. But here's what it said. Millennials and Gen Z are gambling on a big mortgage rate drop using ARMs and refinancing, but that could be a financial ticking time bomb. So your first reaction to that headline, you seen this?
Ticking time bomb is probably a little bit extreme. What I would say is that if you replace ticking time bomb with a pretty serious pain in the neck, you got to go to the chiropractor to get it worked out because it's really hurting. These ARMs, if rates don't come down and your ARM rate increases based on what you originally got, so you were at a 5% rate, the ARM rate went up, let's say 2%, just based on the way that you're required to qualify these days, ticking time bomb to me means rate skyrockets, you can't pay it, and you're probably facing severe delinquency up to and including possible foreclosure. They being the lenders these days, underwriting guidelines and the way that federal regulations have mandated mortgages be written and qualified. It's more like it could be a really big nuisance, and you will cancel vacations and shorten Christmas lists and maybe decide to buy a little bit lesser vehicle than you wanted to buy. But I don't see it being a ticking time bomb. Now, we're always trying to make the best, most sound financial decisions possible. So the importance of the article, I think, is to open people's eyes to the fact that you only want to get into an ARM if it is going to meet your financial needs. And oh, by the way, a lot of people don't even realize, how could this play into their financial picture? Could this really derail certain plans that they had and cause them to maybe add an extra year to retirement before you could retire, or have you cancel a vacation? Or those things are real, and we want to know before we get into the ARM, are we willing to take that kind of a gamble?
Well, here's a nugget from this Fortune article, which again is in the show notes for you. But obviously they're pointing out that mortgage rates did peak in a couple of years ago in 2023 at around 8%. They've gotten down to the kind of the mid sixes, and that's kind of where they've held, and maybe will kind of hold steady here for a little bit. I think people still have this idea of 2 and 3 and 4% in the back of their mind they're hanging on to. But a survey, and again, this is a smaller survey with 1,000 Americans by a San Francisco-based mortgage tech provider. They showed a whopping 2/3 of recent young home buyers are going this route of choosing the ARM. And the whole idea being, we hope that in the next few years, rates will be back kind of where maybe people think they, or maybe hope they will be, maybe below 6, around 5, who knows what the idea is. But the ideas, or the goal here is get this ARM, pay the lower payments up front, and then hope for the refinance and down the road. So as we get into that, Bill, a little bit, and whether or not this is a good idea, a bad idea, and why it might not work, explain the ARM again for those that are maybe considering that aren't completely sure how the ARM operates.
Yeah, so ARM stands for adjustable rate mortgage. And actually it's a hybrid. The ARMs that are being discussed here it starts off with a fixed period and then it turns into an adjustable rate mortgage. So either the first 3 years, 5 years, 7 years, or 10 years are fixed in. The most common ARM is a 5-year ARM or a 7-year ARM. So that first 5 years, the interest rate's going to be fixed in at a rate that is lower than a 30-year fixed. Because in order for you to give up the security of a 30-year fixed and enter into an option that is more risky, the benefit has to be there. The benefit's the lower rate for the first 5 or 7 years. And we'll kind of stick with all the 5-year scenario for the rest of this conversation. So your rate's fixed for 5 years. After that time, it can adjust. And the adjustments, there's limits on the adjustment. Usually the first adjustment can be a maximum of 2% up or down. So if you started out, let's say you got it at a 3% arm on a 5-year arm, your first adjustment's going to go up roughly 2%. So now what's that payment going to be 2% higher? And max adjustment over the term of the loan is either 5 or 6%. So 3% could go up. If it went up 5%, okay, you would be at an 8% rate. If it went up 6%, you'd be at a 9% rate. Okay. So the question becomes, with this type of product, worst case scenario, if the rate went up, could you afford the payment? And usually the answer is yes, because lenders make them a little harder to qualify for. They put a little bit of a safety net built into the qualification so that if rates go up, you're not going to be in that do or die ticking time bomb situation.
Okay, that's a good breakdown. Is there what would be the worst case scenario then, Bill? If let's say you decide to go one of these routes, you decide on an arm, that's the route you want to go. You hope that rates go lower. What's the worst case scenario here? Because that's kind of what I'm thinking when they say ticking time bomb. I mean, how much are we talking about in terms of your payment increasing potentially?
Well, if you started out at 3% and the rate over time, because it can't change in the first adjustment period, maximum is 2%. So if you went from 3% to 5%, and let's say it adjusted every 6 months thereafter, and the rate kept going up, and each subsequent adjustment was a max of 1%. So eventually you got yourself up to 9%. So from 3% to 9% is going to be a significant jump in payment. So Ben, if you borrowed $500,000 at a 3% interest rate, your principal and interest payment on that would be $2,483 a month. If that rate went to 9%, then that payment would go, principal and interest would be $4,398. That's an increase of $1,915 per month. So that's a pretty dramatic increase. Now, if you look over time and you see that 30-year fixed rate mortgages haven't gone to that number in a long time, over 20 years, or the idea is if you got into another arm today, instead of it going to 9%, you'd be somewhere in the fives. So you could limit that. So this ticking time bomb scenario, worst case scenario, an increase of $2,000 a month, it's highly unlikely. Is it possible? Yes, but not very probable. So we've actually helped a lot of our clients use an ARM product, not nearly to the ratio that this article suggests it's happening. And I would definitely say that there's probably a little bit deeper dive into that data subset would maybe reveal some things that would be telling. We don't see anywhere in the industry any published data that says that ARM adoption rates are anywhere near that at this point. For us, it's more like 5% of the people that we work with. But for a certain group of people, it can absolutely make sense. We work with some very affluent folks that say, if it goes higher, I'll just pay off the loan. I don't care. Or, hey, I know I'm going to chunk this loan down dramatically over the next few years, or a few years out, I'm going to sell another house and pay it off. Or I've just got enough money to take the chance to do it. In Canada, there's no such thing as a 30-year fixed rate mortgage. The longest term's a 15-year or an ARM. There are a lot of countries you can't do anything but an ARM, essentially. And We're really grateful for the 30-year fix for a million reasons that we've talked for on this show. I believe the 30-year fix is the best option for 95% of people out there, including myself. But there are situations where the ARM makes sense. And in those situations, we would definitely employ and recommend that product. At this rate, as Fortune has suggested, this rate of people doing it, I think that's a little bit absurd.
Well, again, as I mentioned in the beginning, it was based on 1,000 people surveyed by a tech industry or tech company out in San Francisco. Because so things are, it's a very specific survey probably there, but it's interesting nonetheless that many people that were surveyed were going this route. So I want to get more information, and I think you've done a good job providing that today, Bill. But I know anybody that has questions about these different options, that's kind of one of the things you discuss in that initial meeting, right? If you want to text the word Lynn to 21,000 to begin that process, these are some of the things you'll talk about.
Yeah, absolutely. And Ben, I think this was a great article to bring to the surface because, like you said in the beginning, a lot of these articles are clickbait, a lot of them. Now, if this article scared somebody away from doing an ARM, I think there's nothing wrong with that because you're by default, we'd much rather you read something that makes you more conservative than more, ultra risky for sure. But I love bringing these to the surface because it takes a deeper dive to really understand what's going on here and really how it affects you. And to your point, the consultation we provide is going to apply an ARM to your anybody we talk to. We always look at all the options. Would an ARM make sense? Is this product the best product to meet their financial goals? So that consultation is where we are going to start that process, which is usually about a 15-minute phone call to get things started.
All right, very good. Learn more at smartmortgageshow.com or just text the word Lend to 21,000. Hopefully this helps you out a little bit, understanding ARMs a little bit more. Maybe not quite a ticking time bomb, maybe an extra trip to the chiropractor, as Bill said. But either way, you want to be informed before making a decision.